Well, folks, one more time, I wanted to welcome you to the next installment of the Maximum Performance webinar series presented by the professional coaching company Maximum Acceleration. My name is Eric Janesco. I'm the head coach and CEO here at Maximum Acceleration, and today's programming focuses on a topic that's kind of near and dear to my heart. One of the things I really have enjoyed and really passionate about is providing a layer of education and value that can help really make a difference in the lives of the people that we have the opportunity to work with and serve. I've been doing professional development full-time since 2004, specific to the mortgage and real estate industry. Prior to that, was an originator and a wholesale account exec for several years before that. I've been doing mortgages since 1996, and over the course of that career, I've had the great privilege and honor of being able to work with some of the top originators in the country, and some of the best in our industry. And one of the things that I've always had a passion for is making a difference in the lives of individuals. In fact, that's one of the reasons we started this Maximum Performance webinar series to begin with, is we wanted to bring together a community of folks who were committed to investing their time and energy in learning how to refine their skills and perfect their craft so they could make a bigger difference at the consumer level. And one of the big topics or challenges of the consumer experience, and one of the things that is probably the biggest obstacle to a borrower's ability to obtain a home loan, their dream of homeownership and all the value that can create for a family, from a financial wellness and growth perspective, is the obstacle of credit. In our American education system, very rarely is there any discussion of how to handle or manage a budget for credit at the elementary, junior high, or high school levels. I mean, my own personal experience is a case in point of this. I walked into my Commons building and on campus my first day of school in college as a freshman, and literally within 15 minutes walked out with over $3,000 in available credit limit. Which very quickly escalated into, being buried and overwhelmed. And it took the next couple of years of being a struggling college student to dig my way out of that, working my way through those first couple of years of college. And that was something that always kind of bothered me. And as a mortgage and real estate professional, and as somebody who was passionate about making a difference in the lives of individuals, I really realized that one of the things that people don't get is an education on how to manage their credit effectively and how to build a positive credit score. So I've asked a good friend and colleague, a gentleman by the name of James Charlet, to join us today. And James is one of the true experts in the field of credit management, and credit scoring accuracy. We all know as an originator that one of the biggest obstacles is that silly thing we call a credit score. And we know that the challenge is that buyers, they get desperate, they get discouraged, they find that the obstacles and challenges of getting a deal done and being able to help them achieve their goal. Like, for example, I left retail origination in August of 2002 after 4.5 years of building an office in an area right outside the gates of Fort Leonard Wood. And I had the privilege and honor of working with hundreds of families in that last year, many of which were folks that had some bad things happen to them. They had some challenges credit-wise, but they had, they'd fallen on hard times. I remember one of the couples that I did a loan for, he had been injured at work, and he blew out his knee, and he was off work for about 90 days, 2.5, 3 years prior. We had a lot of derogatory credit that had come along. He had some late pays and slow pays, some 60 and 90-day delinquencies. He had some medical collections that he had paid that were still showing as inaccurate on the credit bureau, and a couple of things like that. But then he cleaned himself up, and he'd been good. He'd gotten back on track, and he got some disability insurance in place that would help him and his family not have such a challenge financially if anything were to happen again. But at the time, prior to 2002, the industry wasn't as dependent on credit score as they are today. And so after, doing a letter of explanation and talking about what had happened to cause the period of derogatory credit, and then helping the client get back on track and making sure that they had been clean for 1.5 or 2 years, we were able to help that family get a home using an FHA loan. His credit scores, I think, were 618, 616, somewhere in there. They're in the low teens, 600 and teens because of all the derogatory credit that was there. The challenge it was when I got back into origination for a short period of time in 2010, the industry had become so married to this thing called a credit score and a minimum FICO. I looked at a borrower who had almost an identical situation happen to him. They'd had an income disruption 3.5 years ago. They had had some derogatory credit that resulted because the husband of the family was out of work for 90 days. And as a result, they had low credit scores. They had I think the borrower at the time on that particular loan in 2010 had a 626 middle credit score. At the time, my best lender for an FHA loan had a 640 minimum FICO. So I had to figure out how to get that customer to work with managing their credit better to get those scores up over a 640 by looking at how to correct the inaccuracies in the credit report. I also needed to educate the family on what the differences were between a $400 balance on a credit card that had a $450 credit limit versus splitting that to a $200 balance across two different credit cards that had $500 credit limits, and what an impact that would have to score by getting their overall total debt to limit ratio below 50%. Which was one of the other key steps we had to work with them on, educating the client about how the credit scoring model works. So today's program, we're going to dig pretty deep into what are the things that trigger credit score, what are the most important factors in educating clients on how to accurately, ethically, and honestly manage their credit better so they can win the credit scoring game. I mean, the reality of it is that the credit scoring model is all about creating a number, right? And that number is based on risk, and it's intended to be a mathematical calculation of a borrower's overall credit risk. In other words, the likelihood of them repaying their debts or not. From a lender perspective, that's what that number is supposed to show us, right? I mean, we get positive points for responsible use of credit in the past. We get negative points for irresponsible use of credit. And the balance of those positive plus negative points is supposed to be what generates a credit score. The problem with that concept is that if the information in the Bureau report is inaccurate, well, that score no longer becomes an accurate representation of that borrower's willingness and ability to repay the loan. So when we do the process of pre-qualifying a borrower as a lender, one of the things we find is, and if you think about every 10 customers we talk to, right, out of 10 customers, probably 1 or 2 have perfect credit, or at least good enough credit that the score is high enough that we can get them a loan easily and they qualify, and we don't need to do any credit correction or credit investigation. But even in today's risk modeling and the way that lenders price loans today, I mean, just think about the difference. Even with fairly good credit scores, the pricing differential between a 695 credit score and a 705 credit score, or between a 735 credit score and a 741 credit score. How much less expensive is the loan for the borrower with the 745 credit score versus the 735 credit score because of the risk-based pricing differentials, right? So even customers with fairly good credit could benefit from better education, better guidance, better support in helping them improve their credit scores. But we all know that probably out of every 10 borrowers we talk to, maybe only 1 or 2 fall in that green bucket, ready to go immediately, easily approvable score range. The second bucket is the questionable They have marginal credit. They're a 664 or a 662 credit score, middle score, and we're trying to get them a conventional loan versus having to go FHA. And with a less than 680 credit score, they're going to spend a lot more. And they're so close to the razor's edge. If any one thing changed in their scoring model, they dropped from a 661 to a 658, and all of a sudden the loan would be gone in a flash, right? Well, those are the ones we've got to work with a little bit. We've got to help them. We've got to educate them. We've got to make sure that they understand at the very beginning of the transaction what things could change moderately, even a couple of dollars difference on a credit card balance because they go ahead and decide to buy the drapes or the furniture ahead of time before closing the loan could kill their loan for them. So we have to educate them as part of the lending process. And then, of course, you've got the customers who really do need some help, like that borrower that one of those first applications I did in 2010 after being out of originating for 8 years. That borrower who had a 633 FICO, and I needed to get them up to a 645 to be able to qualify. Well, I needed to educate them on adjusting their management of their credit balances so that their overall debt-to-limit ratio was high. I needed to educate them on how to get a collection that was showing up with inaccurate dates corrected so that it could be scored effectively, because the third-party collection company was misreporting the opening date of that account, so it looked as if that collection was a brand new collection from 6 months ago, not the original debt as it should have been reported from 6 years ago. It was still a collectible debt. They still owed it legally, but yet it shouldn't have been lowering their score anywhere near as much as it was because it was being reported inaccurately. Okay, so those are the ones that we've got to incubate. Those are the ones that we've got to work with over a period of time. Those are the ones that we need to coach a little bit. And then, of course, the bottom layer of that is the folks that, they're in such a sad shape, they're in such poor case, that we may never be able to work with them. They're just habitually credit abusers or misusers, and they are not responsible. And behaviorally, we wouldn't, one of the first things I learned when I was in the industry, and I had the opportunity to, when I first got started in the business back in 1996, I had a great mentor who was a very knowledgeable, a very experienced originator, who was very, a long time career. He'd been in the business over 30 years by the time I started working with him in 96. And one of the first things he told me is, you sit down to do a pre-qualification, ask yourself the question, would you loan this customer the money if it were your money? Would you give them the loan if it were your money? And that kind of showed me a dynamic or a perspective on thinking like an underwriter and putting myself in the investor and lender's shoes to see if that was something that was worth fighting for, right? Because I think a lot of us as originators today, begin to realize that part of our role is being an advocate for the customer and helping fight for the loan for them. But one of the challenges of that is we've got to be very, very careful that we don't go overboard with that, right? One of the things you've got to be keen to consider here, and by the way, one of the things that we talk about in this model, and we're going to introduce you to an opportunity to find out more about how to really truly become educated on credit, how to be an educator to your community and to families in your community, so you can pass on the knowledge you're going to gain today to them and really help them improve their financial future. But along the way, one of the things that we've got to begin to realize is we are not talking about credit repair, and particularly credit repair of the late 90s and early 2000s as it was historically done. The basic pattern of credit repair was blanket disputes of any derogatory on the bureau. It's not my debt claim, and there's even, the popular article that was published, I think 06 or 07, from a law firm out of Southern California, basically claiming that the credit report is not a legal record; it's a for-profit reporting that is punitive to consumers, and therefore, the consumer has a right to essentially claim. Well, you got to be careful. As an originator, one of the things you've got to consider is, think about, for example, the definition of loan fraud. What does it mean to commit loan fraud? Well, the definition of loan fraud, or mortgage loan origination fraud, is willfully and knowingly misrepresenting information for the purpose of obtaining a loan. So the old days of credit repair, of the "it's not my debt, get it off my bureau" type of thing, knowingly and willfully suppressing information that would otherwise prohibit a borrower from qualifying for a loan, is in fact the definition of loan fraud. And think about it from just a moral and ethical responsibility for just a moment. I mean, so let's say you're doing a loan for a customer who has a unredeemed balance on a repossessed auto loan from 3.5 years ago, right? Let's say there's a $6,000 balance on that account. Well, you either allow that borrower to go to a credit repair company or the old-style credit repair companies, or you even introduce them as an originator to one of those credit repair companies who claims that that bill is not the borrower's and gets that information off the bureau, right? Credit scores come up, you close the loan, everything looks good and happy. However, what if the collection company who is representing that auto loan that has this $6,000 unredeemed balance actually pursues a legal judgment against that client? So after they've closed a mortgage with us, they get sued for the unredeemed balance on that debt that we allowed them to suppress. That judgment gets put into a a wages garnishment, and all of a sudden the borrower can't pay his mortgage. Well, who's the first person he's going to throw under the bus when the foreclosure attorney talks to them about how to defend their home and not lose their house, right? Well, the first thing the lawyer is going to tell the customer to say is, well, my loan officer told me that it was okay to omit this debt from my credit report for the purpose of obtaining the loan. I mean, we've got to think layers into the future as originators in today's environment. Keep in mind, our NMLS ID number as originators is tied to every loan we originate. The attorneys, in the litigious society in which we live, know what we're doing, and they know who to sue. So you got to be careful that you don't cross that line of misrepresentation. Now, that being said, what is to say that credit report is just being reported inaccurately, right? I mean, let's say that repossession was showing as if it was a brand new repossession that had happened just in the last couple of months, and so therefore it is lowering their credit scores. And let's say that's the only derogatory on the bureau, hypothetically, right? Well, let's say if that was the case, if it was the only derogatory on the bureau, otherwise we would estimate the customer would have a 7 or 720 credit score, but with a unredeemed balance on a charged-off repossession that is scoring as if it happened 3 months ago, is going to hammer their score for 70 or 80 points likely, maybe even as much as 100 points. But when you investigate what the actual original date of delinquency was on that account, it turns out that the repossession may have happened in 2009 or 2008 when the guy lost his job because of a recession, cutbacks, layoffs that took place back in 2008 during the recession, right? Well, yeah, he couldn't make his car payment when he was laid off for 8 months, so yeah, he fell upside down on the car. Yes, he still owes the unredeemed balance on that repossessed automobile, and legally the borrower is responsible for repaying it, and legally the creditor could sue them for that and win a judgment and garnishment. But it shouldn't be an 80 or 100 point deduction to their score because it's 5 or 6 or 6 years old. It should only be a 20 or 30 point reduction. So if it were accurately reported, would it hammer his scores as hard as it is? And that's what we're kind of talking about today in what we're doing. Well, one of the reasons I was really excited to be able to introduce James to all of you is I had an opportunity to see James speak a couple of years ago. I guess we've been working together for about 3 years together now. But back in 2012, I saw James speak at one of the national conferences that I was also speaking at. And I literally learned more from James in a 45-minute presentation that James gave than I had learned from a 2-day training conference that had been put on by Equifax that I attended back in 2008. And just the level of information that James was able to share with me in such a short period of time taught me that James is one of the true experts in the credit field, and things that I had never even thought of, because I used to think that credit is pretty black and white. It's there or it's not. And I was used to working with or hearing about companies like the traditional credit repair companies that would do blanket disputes of everything. So the only way I knew of to correct a credit issue if I had a collection that was being inaccurately reported was just to dispute it, remove it completely, which really isn't ethical if you think about it. In fact, in some cases could be construed as committing loan fraud. Well, what James shared with me is that it's more often than not, it's the nuances of exactly how the debt is being reported that make the biggest difference from a scoring perspective. One of the reasons he has such a great depth of knowledge is, he was an executive for Experian. And James, if you don't mind, just update them on kind of what your history and background is, if you wouldn't mind.
Yeah, absolutely. So I was part of CAS, Consumer Affairs Special Services. We were an adjunct to the executive team that handled all the legal and compliance issues that Experian had to deal with on a daily basis. We were a very small team. We were particularly loathed by consumer advocates. We were the ones that when Experian would get sued in federal court, we were the ones that came in to testify as Experian in federal court. We dealt with the FTC, unlike what the CFPB does now. The FTC wouldn't relay us individual complaints for consumers. So every quarter we would get basically a spreadsheet that showed us the categories in which we were getting the most complaints. Typically it'd be about 35,000 complaints per quarter. And we'd have to respond with other spreadsheets and bar graphs showing what we were doing to address those broad trends of concerns. Every day though we would also get about 80 Attorney General complaints, both state and federal level, 80 to 100 BBB complaints, 35 UCC complaints, and 10 to 15 congressional inquiries. If you contribute enough money to a congressional campaign, if you work on a campaign, if you have a nice enough relationship with your congressman or senator, they will actually go to bat for you with the credit reporting agencies for their constituency. We would get, and like I said, every day 10 to 15 different questions regarding a constituent for a congressman or senator. And here's the real kicker. As much as obviously my job there was to defend Experian and our customers, you guys, everybody that you see walking down the street, that's not our customers. Our customers at Experian were American Express and Capital One and Citibank. Those were the companies that paid us a lot of money to store and then re-render their data for them and do forecasting and all that kind of fun stuff, statistical analysis. They're the ones that paid us millions and millions of dollars a month to take care of their data for them, and that's who we were there to protect. When we would get sued, they weren't just suing us; they would sue us and our competitors, TransUnion and Equifax, and they would sue if it was a collection involved the third-party collector and the original creditor. And kind of like a good attorney sues everybody and lets God sort them out, and that was what we had to deal with on most cases. But what they did have in common, the vast majority of those complaints that had gone to Attorney General or they'd gone to their congressman or they hired an attorney to sue us. By the way, we did get sued every single day, 5 times a day, and we had legitimate threats of lawsuit 250 times every single day. And then when I say a legitimate threat of lawsuit, everybody likes to write down on their legal pad, hey, I'm going to sue you. When I say legitimate threat, that means it's on, Wolfowitz and Stern's stationery saying, hey, we've been retained and we're going to sue you. So that's a legitimate threat of lawsuit. In any case, every one of those individuals, almost, there's always that crazy exception, but the vast, vast majority of them had something legitimately wrong on their credit report. It was misreported. It was not reporting limits on a credit card. It was, like we talked about, collections, a wrong original date of delinquency, showing a balance when it's already been paid multiple times, double reporting the balance, all this different myriad of, absolutely incorrect information that's incorrectly influencing the consumer score to a very negative percentage. And almost all of them as well had tried to go through the normal channels, and they weren't able to get any satisfaction. They, the credit reporting agencies love to say that it's easy, just you can do this on your own. Just send us a letter and let us know what's going wrong, and we'll get it fixed for you. No, they won't. Unfortunately, in most cases, and there's always those that they get somebody good. You happen to have that veteran that knows what they're doing and sees your letter and reads it and actually wants to help. Those people do exist at Experian, of course they do. Unfortunately, they're the minority, and usually it's not that they're trying to be bad or to do something wrong. They're just either lazy or incompetent. I mean, it's a huge turnover rate when you're talking about the consumer, the people that are dealing with consumers within the credit reporting agencies. So in any case, what I saw was that we're getting sued all the time and having all this stuff happen for problems that we really do have, and we prefer to just sweep them under the rug. And yeah, we have a really good team to deal with it once it escalates that issue, but that's the way all these issues should be handled. And so the other part of it also was, of course, for every one of these people that has the knowledge and the resources and the wherewithal to hire an attorney, to go to their congressman, to go to their attorney general, how many other hundreds or thousands of people have those same issues and they don't have any way to find satisfaction for themselves? So anyway, that's what was keeping me up at night. That's what led me to leave and go on to the consumer advocacy and credit services side. Right. In a large nutshell, I suppose.
Well, I'm guessing that's why, and James, you and I have talked about this in personal conversations over dinner, the fact that, that's a big part of why you started CRE Credit Services and why you're so passionate about it. And, of course, by the way, for those of you who, big kudos to James and his team. They were recently featured in an episode on Lifetime Television with, what was the name of the show that they're doing?
The Balancing Act.
Balancing Act, right.
It's kind of their answer to Good Morning America. It's the Women's Television Network morning show.
Oh, awesome. Great. That being said, I'm going to go ahead and jump into the Q&A mode here, James, and there's a couple of great comments that have come in so far here. From Todd, customer disputed an account and it will be resolved, but still shows as disputed on the bureau. How do we get that disputed language off the report? That's a great question that I'm going to have James address for you.
Okay, and there's a couple things I want to talk about that question brings up. First of all, I know that you have to for Desktop Underwriter, but and this is one of those things it's a great example of where laws conflict and policies conflict, and kind of an example of what we talk about through the rest of the course. Because in this case, the consumer has the right to add that disputed language, whether they truly do or not anymore. They have the right to do that, and they're not supposed to be punished for it. The Fair Credit Reporting Act gives consumers the right to put a statement of continued dispute on any trade line that they disagree with what's being reported about them. The Equal Credit Opportunity Act, on the other side, says that it is a violation of federal law, a violation of ECOA, to not lend money as a result of someone utilizing their rights under the consumer protection laws. Well, obviously the Fair Credit Reporting Act is consumer protection law, so not lending to them because they put that code on file is a direct violation of federal law. So that's one side of it. Of course, the other side is, in the real world, we know that they do, for mortgages, not lend as a result of those having on there. In fact, Desktop Underwriter will kick them right out. I think it's also probably important to understand not all dispute codes are going to even impact the score. The problem is that Desktop Underwriter can't tell the difference between an XC and an XB dispute code. XB dispute codes will impact the score. Those are the codes that come on during that 30 to 45-day window where something is actually under investigation. And what happens is when the account is being investigated by the credit reporting agency, it's going to suppress the balance and payment history, so the score will be artificially increased. Now, obviously, that's what Freddie and Fannie and Ginnie are worried about and why they have that in Desktop Underwriter. The problem is those codes that you see more commonly, account was in dispute, now resolved, consumer disagrees, those canned continued dispute statements, those have no bearing on the credit score whatsoever. It's the other type of code that's only on there for a limited amount of time where you'll see the score fluctuate quite a bit when that happens. Now, with all that said, getting them off is a matter of understanding what they are. they are consumer compliance codes or special comment codes or subscriber compliance codes. And when you're somebody that works at a credit reporting agency, when you're taking these disputes from consumers and putting them into the system, you have to understand what they are. Well, most of these people came from customer service. When you say, hey, remove that dispute code to them, they don't know what you're talking about because that's not what they're called internally. And they have never worked in mortgage, or most of them are young, have never even had a house. They wouldn't even understand what we were talking about when we say a dispute code. When we say, hey, remove consumer compliance code 432 from trade line 8 on the Experian report, then they know exactly what you're talking about. So sometimes getting them removed is just a matter of being able to speak their language. And so that's when we're doing it, that's what we do. And if we obviously, if you were to call and ask us, we'd tell you what kind of code you're dealing with. And there's a few different ways. Obviously, CRE deals with that. Theoretically, the consumer should be able to do it themselves, but there's a lot of red tape there and problems. More likely than not, it would either be us taking care of it or you going through a rapid rescore to take care of it. Because in rapid rescore, what you can say is, everything in the credit report is required to be accurate, complete, and verifiable. Obviously, you've got a consumer saying, I don't dispute it. You've got a trade line saying, I do dispute it. That's an obvious false information. And so doing it in a rapid rescore where the customer signs a letter saying, I don't no longer dispute the status of this account, and getting that notarized and doing it as a rapid rescore, that works. And then also the way we do it is typically contacting the credit reporting agency directly on the consumer's behalf.
Right. James, there's another question that popped in here that is actually probably part and parcel with one of my favorite things that actually one of the most impactful things you taught me in some of those early times that we first connected is the issue of collection payoffs, right? Underwriting is saying, you need to pay that $220 collection to Verizon Mobile before we'll let you get a loan. We pay it off, and all of a sudden the borrower's FICO's dropped from a 670 to a 630, and it kicks them out of an FHA loan. Why is it that the score always drops, and what can we do about it when paying off collection balances? Sure.
Well, and unfortunately, I know that that's the case. I know that any loan officer with any kind of experience in the industry has seen that happen, has anecdotal evidence that you pay a collection, the score goes down. We've all seen it happen. The fact of the matter, though, is, and this just, from a logical perspective, you're going to understand why, there is no credit scoring algorithm in this country that's designed to punish you for paying off a collection. A credit score rewards you for responsible behavior. Your score goes up for responsible behavior, and your score goes down for irresponsible behavior. Economists might not always see the full picture when they're putting in the risk codes, but certainly they understand that going and paying off a collection is not irresponsible behavior. So there is no scoring algorithm that's designed to punish you for that. What I can tell you is that in every single instance, unless there's something we missed, and maybe they went delinquent on another account or they maxed out their credit card, obviously those can offset and make it look like paying the collection went down. But if nothing else has changed at all and the score went down, I can promise you that's because the collection company did something illegal. They put the open date in, or they put the paid date in the original date of delinquency field. They coded it as an installment or a revolving account, so they said it was open instead of closed, which obviously all third-party collections by definition are closed account. All derogatory accounts are closed accounts. So that's why the score went down. The score should not go down. If everything is reported properly, it doesn't help you very much to pay off a collection, but it never should hurt you. Obviously, if we're giving customers advice on how to deal with the collection, the first thing that I would always advise is I need something in writing that explains to me how they acquired it, where are the documents for the original creation of the debt. I've had too many of my clients and even consumers that I've seen through Experian that they paid the same debt 3, 4, I've seen it as many as 5 times, that they paid a debt to different collection companies, and the collection company would take their money and then re-portfolio the debt and sell it to someone else to collect on it again. And it's obviously, yes, it's underhanded, yes, it's unscrupulous, but yes, it also still does happen very frequently. So I want in writing to verify that they are truly the owners and proper collectors of that debt. Before I'm going to want something in writing stating that they're going to that debt is going to be zeroed out forever once they pay it. Once my funds clear for them, and even then, I'm going to try and negotiate for them to remove it. That's another part of it. Federal law says if you report to a credit reporting agency, the information you report has to be 100% accurate, complete, and verifiable. But remember, it's if you report. There are plenty of companies, credit unions, collection companies that choose not to report data to credit reporting agencies. It's expensive to report, so there's nothing illegal about them agreeing to remove that, especially when it's a utility or a medical debt or things like that, which I happen to kind of be of the opinion that those shouldn't be included in your credit history to begin with, considering it has to be complete. Are they showing all the other positive payment history you made to that doctor over the years or that utility company over the years? And if not, how is that conforming with the standard of being complete and verifiable? But I digress. That's a little bit of a different conversation. Nonetheless, making sure that either they're going to remove it or having it in writing exactly how it's going to be reported after the payment is typically going to be the best way to make sure that paying the collection does not negatively impact the score. Getting it in writing that they're going to report it as a closed third-party collection with a zero balance and original date of delinquency commensurate with the original creditor is the way it's supposed to be reported anyway.
Right. James, do me a favor, and one of the things you shared with myself and that you shared with other audiences that was one of the more profound understandings. Go into original date of delinquency, date of last activity, and clarify how that, one, what they mean, what the definitions of them are, and two, how it should or should not affect scoring.
Sure. Well, let's start with the date of last activity, because I think that's one of the biggest misconceptions is that the date of last activity has anything truly to do with credit reporting, and it doesn't. The reason that on mortgage reports you so often see date of last activity is because that date is exceptionally important when determining the validity of the debt itself. There's two different standards that every trade line has. One is the retention time, the federal retention time, which is how long can it stay on a consumer credit report, and that has to do with ODD, which we'll get to momentarily. And then the other is the statute of limitations for collection of the debt, and that's going to define how much time, when did the time start running that if this consumer was not paying, I could sue them. So if they stop paying today, how long would I have to bring a valid lawsuit against them? Just for explanatory purposes, I'm going to use Texas. Texas has two different statutes of limitations, one for open debt. So open debt is going to be like medical, utilities, credit card debt. Anything that's not collateralized pretty much is going to be open debt. And that is going to be a 4-year statute of limitation from the date of last activity, which could be different than the original date of delinquency. Date of last activity is the last time that you did something to reaffirm your contract with them. So maybe I went delinquent 6 months ago and I haven't caught up. I'm still 5 months past due and I've never been less than 1 month past due, but I did make a payment. So that's going to make the date of last activity when that last payment was made, even though because it never was current again, I never actually caught up, that original date of delinquency is going to stay the same. So date of last activity is going to be the last time you actually reinforce that contract, and that's how long they have to sue you. If they go beyond that, so if it's a credit card and you haven't made a payment or used the credit card in 4 years and 3 months, and American Express sues you today in Texas, and you countersue claiming an affirmative defense that the debt is statute limited, you're going to win your lawsuit and they're going to lose theirs because it's past that statute of limitations. Okay, so that's why date of last activity is a very important date, but it's not there for credit reporting purposes. The most important date for credit reporting on any potentially negative account is the original date of delinquency. It is, beyond a shadow of a doubt, the most litigated concept in all of credit reporting, and it's the date from which the 7-year time frame starts to run that negative information, not just the negative account, the negative information can stay on file. Now it's relevant, and the reason I say negative information is because it doesn't just define the trade line. It also defines the balance, the past due balance associated with that trade line. So what that means is that trade line, if that balance never comes current again, they're never current on that balance, it doesn't matter who owns the balance, who's reporting the past due balance, that negative information of the balance can only be on the credit report for a maximum of 7 years. So if let's say you went delinquent with a Chase account in October of 2008 and you never made another for the payment again. So, 30, 60, 90, 120, 150, 180 charge off, and it's been charged off, and Chase has been trying to internally collect it ever since. And today they give up and they go ahead and sell it to NCO Financial. NCO Financial opens an account today, September 1st, reports it to your credit report. They can only legally report it until next month. Next month is 7 years since your original date of delinquency with the original creditor, since that balance went past due. So even though NCO, as a third-party collector, opened that up today, federal law states they can only report it for a maximum of 7 years from the original date of delinquency with the original creditor. Now, I can't see your hands, but if anybody that thinks that even 1% of third-party collection companies dutifully follow that law 100% of the time, raise your hands. Doesn't matter that I can't see them. I think you all know I shouldn't be seeing a single hand. And I'll tell you, there's a lot of other little concepts that kind of dovetail with that as well. Another one is that the original creditors tend to sully their hands. When they sell it to that third-party collection, can Chase continue to report a balance? Of course not. The consumer only owes it once. It has to be accurate, complete, and verifiable. So when the first-party creditor sells it to the third-party collector, they're required under federal law to change theirs to a zero balance. Okay, the consumer doesn't owe it twice, right? Also, again, the consumer only owes it once. So any time that a third-party collector sells it to another third-party collector, so if NCO sells it to Asset Acceptance, who sells it to West Asset Management, in each of those instances, as soon as NCO transferred that debt to Asset Acceptance, they're required under federal law to delete their trade line from the credit report. Likewise, when Asset Acceptance sold it to West Asset Acceptance, they're required to delete their trade line from the credit report. You can only have one third-party creditor with the balance, and on the original creditor with a zero balance reporting for any given balance or any given debt at any point in time. Anything more than that is also a violation of federal law.
All right. James, I know that you've got a ton of information to share, and we'll take just a few more minutes to address a few more questions for those of you who are logged in still and able to participate. We'd love to see some additional questions or comments from you. There's one here that I'll go ahead and kick you off with, James, that I thought was a great question. It's just, what if payment is made directly to the original creditor instead of a third party? I'm assuming in the case of like a third party collections. Will it?
Yeah, sure. It's going to depend on what the relationship is. There's two different ways that third party collections are typically handled. In a portfolio situation, which is the one that we're most familiar with, that's where the bulk of debt from a creditor is put into a portfolio and sold to a third party, typically for some small fraction of what the face value is, 10 cents on the dollar or less in most situations. In that case, going back and trying to pay the original creditor is most likely going to be fruitless. They might not even have a record of you as a customer anymore, just depending on how they went about transferring that debt. Now, the other that's actually become more common is a factoring company. In a factoring situation, rather than taking on the full liability themselves, the third-party collector instead bids a percentage. So let's say NCO and Asset Acceptance will bid against one another. NCO says, well, whatever I collect, I'll take 35%. Asset says, well, we think we can make a profit if we only take 30%, and so the creditor takes them on as their factoring company because it's a lower percentage that they're going to lose for them. Okay, in that scenario, in the factoring scenario, paying that original creditor would probably you'd probably be able to get rid of that third-party collection altogether because the original creditor still retained ownership of the debt. So it's really going to depend on what type of relationship that original creditor does have with the third-party collection to determine whether or not that is a viable option.
Definitely. A quick follow-up to that question, is there a way from the consumer report to tell the difference between a factored collection account versus a sold collection account?
There should be. There's separate creditor code for factoring companies versus third-party collections. And when you're looking at consumer reports, a lot of times you'll see it'll say factoring company under it. So and the funny thing is, like the larger collection companies, they can be both. So you'll see NCO listed as a factoring company sometimes. Now, obviously, NCO is big enough; they do plenty of portfolio acquisition. But it'll say there's times where you see it'll actually say factoring company. Of course, the downside with that, you're probably never going to see that on a mortgage report, or very, very rarely. But if it is being reported accurately and they're given the proper information, you should see that on the consumer report. And you know what, real quick, before I move on, let me go ahead and, that's one of those I always like to dispel, just because it's so prevalent. Everybody loves mortgage reports, and they're great. And for most consumers, that's one of the very few times that they ever see an actual lending score, because they don't really see the credit score that they get for their credit card application, and oftentimes not even for an auto application. But they always get to see their scores for a mortgage application. So there is a very strong belief that the best reports to look at are mortgage reports. Unfortunately, that is not the case. In all instances, the consumer report is going to be more accurate and more complete. Federal law requires full disclosure. All the balance history, the payment history, all the information that's contained about you within their file is required to be disclosed on a consumer credit report. On the mortgage report, whichever bureau you choose to do business with, be it CBCI Novus or CoreLogic or Kroll Factual Data or Funding Suite or whoever it is, they're picking and choosing which information is going into that mortgage tri-merge bureau report. They don't have that luxury with consumer reports. They've got to tell everything. And so it gives you more points of comparison to look for misreported, underreported information.
Here's another question.
Go ahead.
If payments continue to get made, but still threatening to go to collections on certain dates, can they still turn over into collections?
So the question was, if you're making payments to a creditor, it's still past due, but you're making payments. You've made it, and they're still threatening to turn it over to a collector if it's not paid by a certain date. Can they do that? And yeah, the answer is yes. Anytime you're past due, there is no law, no standard, no statute, at least at the federal level. Some states are going to have something slightly different, but at the federal level, there is no standard. I mean, theoretically, you could be one day past due, and they could send it to collection. I can promise you there are bottom-of-the-barrel car lending institutions now that if you go literally one day past due with a tow-to-note place, they've got kill switches that with a GPS unit that they will turn your car off as soon as they see from the GPS that it is at a standstill for more than 10 minutes. They will turn the car off and send a tow truck to come get it for being one day late, and that's legal. So in that scenario we're talking about, yes, you're making, we could call it good faith effort that's being made to try and do that, and some people respect that. I've known, especially doctors and hospitals, that families were making $5 or $10 monthly payments on tens of thousands of dollars of debt, but just the fact that they were paying something, trying to take care of it, that the doctor or hospital weren't sending it to third-party collection. But even in those scenarios, the current chairman of the hospital or the current finance manager of the hospital leaves or gets transferred or passes away or whatever the situation is, and a new guy comes in and wants to change the revenue structure, that can change overnight too. There's, for a lot of those things, there's just not a whole lot of protection. It's very much at the discretion of the creditor you're dealing with. But the bottom line is, once something's past due, they have whatever, in most cases, whatever is at their disposal to try and rectify that.
Yeah, and I'll just follow up to that. One of my suggestions, and James, I've heard you say this to audiences before too, is get it in writing. And the reality is if you can renegotiate the agreement, paying as agreed is per the agreement you originally set with the creditor, right? So if you renegotiate the agreement, they would no longer be able to be reported as delinquent accounts if you've restructured the agreement in writing. It's kind of like a loan modification, right? And by the way, mortgage loan modifications is another area that you get into frequently that more often than not are going to be reported inaccurately versus accurately. So
and I would say on that too, Eric, I mean, that's one of those things where the law is very black and white, so much as it's 100% accurate, complete, and verifiable. But then you get situations like a short sale or a loan modification where how it should be reported, given the language structure that's available to them, is not black and white. And there's a few different ways that could be right. And if a creditor is going for that way that looks that's the most damaging, but theoretically could be right, you certainly have an argument. Is it right? Because there's not a clear-cut definition of what is right in those cases, and to a certain extent, they're guessing.
Yeah, definitely. And it obviously it's one of the unfortunate elements, and one of the reasons you need to be educated on how to read and understand this information, how to identify the nuances of important reporting dates, coding and miscoding. Like, for example, one of the other things, there was a question here about how do you know when a debt is miscoded, like the difference between the I-9, the Y-9. James, why don't you talk about that for just a minute?
Sure. That is just a little teaser. That is something we definitely get into in great depth in the multi-part series, because the best way to really to teach it is to show you actual errors, and really that's what it is. It's knowing what to look for. And just a couple examples: third-party collections tend to be reported inaccurately. At CRE we've had 27,000 clients in the last 4.5 years, and for those clients we've had now about 115,000 collections amongst them, and the error rate, the percentage of those collections, so we're not talking about, I think that once you get up into the 6 digits, that's a pretty good subset. That's enough to make a broader generalization about how this information is reported. From our statistics, you're talking about over 98, closer to 99% of all third-party collections are reported inaccurately at the outset. There's something wrong on them, be it, like we said, the type of account, or we'll give you a few examples for coding on a third-party collection. Number one, it's a third-party collection. It should say closed as the status and collection as the type. If it shows open, if it shows installment, if it shows open in either of those fields, if it shows installment, if it has terms and shows months, that's all wrong. Those are things that are going to make it look to the scoring algorithm as though it's a first party. Likewise, in the 30, 60, 90 columns you see on your mortgage report, if there's data in those for a third-party collection, that's wrong. They were never delinquent. You can't go delinquent on an account that's already derogatory. And those extra months in review of delinquency, in many cases, are going to negatively influence the score and make it lower than it's supposed to be. Okay. What else? You'll see. Okay, we'll get to it. Other things that sometimes it's just a matter of. There's one that we use in the example where they're showing 65 late payments on a charge-off, but there's only 50 months in review. How can you have 15 more months of delinquency than you have total months that the account has existed? And so sometimes it's just that it's discrepancies between how the information is reported on that trade line. And again, that's something that is far too common, more common than anybody would imagine. Okay. So
can you clarify one quick thing for me, James? The correct coding for a collection should be what? What is the actual letter code you're supposed to see on the consumer?
Yeah. So the rating on it. So if it is actually closed is the status and third-party collection is the type, it should code as a Y9, not an O9, not an I9, not an R9, certainly not an R5 or an I5 or something like that. Obviously an I5 indicating that it's an installment account that's 4 months past due. That is going to be much, much, much more detrimental to the credit score than is a Y9 with a proper date, 6 years ago. 6-year-old medical collection, I mean, don't be wrong, it's still impacting more than most people would ever imagine. But nonetheless, it's much less than it would be if it's looking like an installment account that's currently 4 months past due.
Yeah. Actually, personal example of that, you shared with me that actually helped me correct an issue I had. I had one of those Disney movie club type things that I kept telling them to stop sending me the movies, and they kept sending them anyway, and I kept sending the movies back and paying for them, and months after months of telling them to quit sending me the movies. I finally changed the credit card number that they had on file for billing, and then they sent me to a collections. Well, guess what? That collection was reporting as a revolving account, not as an actual third-party collection. And of course, I still disputed the balance because I honestly felt I didn't know it, and I was able to document it, and I was able to get it removed from my credit report. But even just getting them to reclassify it as a collection account versus a revolving account made a 20-point pop in my score. So, I mean, even just with that silly thing of a $69 collection from the company that took over the Disney Movie Club thing.
I know.
Anyway, it's all kinds of goofy stuff like that.
I imagine you probably already spoke about this, Eric, but I mean, obviously that is the appropriate way to do this. Is, you know, just like Eric said, in that scenario, yeah, we could certainly make the argument that you never owed it to begin with, but even if you did and you needed to pay it, or it was one of our customers and they owed it, we're not saying that shouldn't be on there if somebody owes it. We're saying that it has to be reported correctly. And in that scenario, you know, if they had been a 621 and you needed a 640, just getting them to reclassify it as a third-party collection as opposed to a revolving account would have been enough to get them lendable for you. And that's all we want. We want it to be an accurate representation based on proper guidelines and criteria of what the score should be. And that's what the class focuses on, is teaching you how to pick out those actual errors, the problems, the things that are suppressing illegally a consumer's credit score, you know, and determining whether that's something that you can pursue on your own, or you want to you know, go to a professional to help pursue that. Whatever the case may be, it's finding those real errors, those things that are just inaccurate, and getting them fixed. Certainly not about you know, hiding or obfuscating money or balances that a consumer truly owes, because you want to know about that. You want to know how much money they really do owe before you lend them more money.
Exactly. And again, it kind of goes back to that ethics thing I was talking about at the top of the program of, you know, making sure that as an originator, you're educating consumers and giving them the information they need to know to honestly and ethically manage their credit behavior for the benefit of their ability to lend at a better cost. One more question I want you to get handled for me, if you wouldn't mind, James. There's a question here from Tara about, does paying off a current credit card that's in good standing hurt scores?
You want all these to always be black and white, and of course there's always gray area, so it's going to depend. If you have other accounts with utilization, so let's say you've got an American Express credit card, a Bank of America Visa, and and I specify American Express credit card because they have credit cards and they have charge cards. So this one's a true credit card, American Express Clear, Blue, or Diamond, or one of those. And a Bank of America Visa, and a Home Depot card. And you're using all of them, and you're using all of them below 10%, which is optimal, but they have utilization that's being reported, and you pay the Home Depot down to 0. Is that going to impact you? Nah, that's fine. You've still got good utilization on your other revolving accounts. But if you pay all 3 of them down to 0 and let it report as a 0 balance on all your credit cards for a couple months in a row, yeah, that's going to negatively impact you because it's showing that you're not actually utilizing them. They're just sitting there. They're wall hangers. They want to see that not only do you have, the banks trust you to give you revolving credit, but that you also know how to utilize it in a responsible manner. And that's what they, in theory, that's what they believe they get from seeing utilization on those credit cards, is evidence of you being able to responsibly manage not only installment payment history, but also revolving payment history as well.
Right. Right, and that's one of the fine nuances here. Is you know, we would all think, or we would hope, as an advocate of consumer fiscal responsibility, as an educator for helping families improve their financial management, we have to understand that good financial management and good financial habits for the purpose of building a family's wealth is not necessarily what's being scored. What's being scored is good credit management, which means using credit and using it responsibly. So like when you go into those, you know, Dave Ramsey type situation, you know, with the families that are just, oh, all credit's bad, no credit, right? Well, the problem is they have low credit scores because they have no positive history of using credit to outweigh any derogatories or delinquent credit use in the past. And so that's why we talk about it as kind of a fun, as a game, really, more than anything.
There we go. And that's a good analogy for it as well, doing the credit dance.
Oh, the dance. Oh, yeah. You got to have enough of the right points in the right direction, right? One of the things that I've asked James to do, and partly because of his passion and drive for credit, consumer education, and really being able to help creditors consumers. Part of our mission to you all as originators and as real estate professionals is we want to equip you to be able to educate your consumers on how they can win the game of credit scoring and for all the benefits of helping that family improve their financial situation. So what we put together is a very special 5-part series. We're going to go very deep into the nuances of the credit scoring models, what are the things to look for, how to investigate them, what are the ethical and educational implications of helping consumers really make the necessary behavioral changes that are going to enable them to achieve at a much higher level. And so we put together this special 5-part series we call Why Becoming a Credit Educator. And what it really does is it walks you through and teaches you what James and his team have learned and how they work with customers as consumer advocates to help them correct the inaccuracies in the credit bureau, as well as in the educational elements of how to influence the behavior patterns of your clients so that they're practicing healthier credit habits and building their financial future as a result of that. This particular series will be done as a live event one last time. We've run the series twice already, that we did it in a live web shop environment just because of the constraints and demands on James's time. This will be the last time that we're able to run this as a live event. Of course, we'll be archiving it and offering it as a video program in the future. But if you wanted to participate in a live event, starting on September 14th at what will be 3:30 Central Time, we are going to go ahead and do the last of the series, and we'll run 5 consecutive Mondays in a row starting September 14th. Of course, if you go to our website, mxlcoach.com/credit, you can find out more P's and Q's about the course, the curriculum, what's involved, and what each segment will teach. As well as the 5th session, I will walk you through how to, once you have that base knowledge, how to then promote that to your community and offer yourself as an educator and advocate for helping consumers in your community overcome the challenges and hurdles they experience and the overextended expenses that they incur because of low credit scores, because they haven't learned how to healthily, ethically, and effectively manage their credit. So if you go to that mxlcoach.com/credit website, you can enter the shopping cart. The regular price for the program is $497. James has authorized us to go ahead and offer that at a $200 discount if you go ahead and register before the 11th of September. You've got a week from Friday to go ahead and get this punched in. But it'll drop it to $247 to be able to participate in the program. It'll reduce it by $200 if you use the discount code CREDIT, C-R-E-D-I-T, in all capital letters. Again, it's a 5-part series. It's about 6 hours of training that goes really deep into the nuances of the credit score, how to read the consumer reports, how to investigate or help consumers investigate the inaccuracies and then therefore dispute them. Also, a little bit of how to, in the last session, we'll talk a little bit about how you can promote yourself as a credit educator in your community and get in front of dozens of consumers who are hungry for that information so that you become the educational resource for those folks that enables you to do a lot more loans, mortgage loans. You know, I mean, think about if you had a farm club, a farm team of folks that are improving their credit, and you're the educational resource that provides them the valuable information that makes the difference between them being able to buy a home or not. And how many customers will that likely bring you by being out there on the front lines in the consumer groups, trade associations, churches, schools, and neighborhood communities that you become the credit expert in your community and be the educational resource who's making a difference in the lives of families in your community. What would that look like for you as far as loan flow and volume? And so I really want to strongly encourage you that the feedback from the first 20 or so folks who went through the first course and the 30 or 40 folks who went through it the second time we did it, they put about 55, 60 loan officers across the country through this program so far. The feedback was phenomenal. They said it's one of the best educational experiences they've had. We've heard stories of dozens of loans being done since the last time we ran the course last March. And so really want to strongly encourage you to consider making that investment both of time and resource to be able to empower you to become an educational, a credit educator in your community, a leading expert in the field of credit education and credit habit management. for consumers in your community. So you really can make a difference. So like I said, if you want to go ahead and take advantage of that opportunity, go ahead and hop to the mxlcoach.com/credit website, enter it in the shopping cart, and then when you get to the shopping cart, apply the discount code CREDIT, knocks it down to $247 to participate in that 5-part training class that we're going to be doing one last time starting September 14th as a live event. All right, guys.
Yep.
Well, one last thing I'd like you to share, and there were a couple of questions a little ways back here, James. What exactly is CRE Credit Services, and what do you guys actually do? How do you help support originators? If you wouldn't mind, go ahead and address that just real quickly.
Yeah. Well, obviously, that's CRE Credit Services is the company that I founded after leaving Experian. We really don't like the term credit repair, just because of all the previous negative connotations associated with it and some of the bad players in the industry. We prefer to think of ourselves as credit educators, coaches, and correction specialists. We work with the mortgage industry a whole lot. Obviously, we also work with insurance and auto dealerships and other real estate agents, things like that as well. But mortgage is our primary demographic. Originators, when they have people that don't qualify, and maybe it's something that's pretty complicated, or there's just a whole lot of it. I've had customers from Alaska that, just this was in my head, this couple that each of them had over 100 collections, and they were in the mid-400s. But you look at their report, and like 95 out of the 100 collections are less than $30 medical. They were insured. They're like just the most ridiculous little things. There just happen to be a lot of them, because he's like, he's one of these deadliest catch fishermen, and he's at the hospital a lot, and she is as well. But they've never missed a payment on anything in their lives. Their mortgage, they have a mortgage and it's never late. They have credit cards that are never late. But it's all medical, causing them to have this horrible thing. And it's like, to just at first blush to look at their credit report, you're thinking to yourself, well, who would ever want to lend to these people? But when you dig a little bit deeper, it's like, no, of course I want to lend to them. They've never missed a payment on anything relevant to credit in their entire lives. And those kind of people are really the reason that we do this. We always give a free consultation. We do dig into it deep. We get them off your plate as a mortgage loan originator. We get them off of your plate and onto our plate so that you can go and work on the ones that are easier qualifications and ready to go now. And we do that free consultation. We determine, are they really just kicking the tires? Do they really want to move forward? Are there really errors there that can be corrected and show them as a more true reflection of what their credit risk is? And if we find those things, then that's the service that we provide. That's where they would pay us at that point. But the consultation's free, but if there's something that we can do to help them to correct their report and show them as what we believe to be a truer risk that is much less than, or I should say, much less of a risk than what they're being reported as now, then that's what we provide for them.
Right, exactly. Well, guys, think about it from this perspective. You guys go out and do a lunch and learn at a local employer that has 20 or 30 or 50 employees in a local manufacturing company or something like that, right? You go out and do a credit education workshop, credit management workshop for that group of 50 employees. How many of those folks have, extensive, delinquency or derogatory issues that need to be investigated and corrected, that 10, 15, 20, 30, 50 lines of derogatory credit data? You want to help them, but just, when you think about the return on time invested, it's so low payoff of a return for you as a mortgage originator. You'd be much better off to go up and set up the next workshop or work with the 3 to 5 of those 50 families that are in the green bucket or the silver bucket, get them, the minor stuff like, maybe an inaccurate balance reporting on a credit or a collection that was paid that still shows unpaid or something like that. Something you could easily, as an originator, fix through a rapid rescore. We'll get them, take those 5 to 7 that qualify, and then work with CRE to support the more complicated, more detailed, and more involved cases to outsource some of that credit education, investigation, and correction services to CRE so that they can take on the workload for you and handle that because they're skilled to do it. 1, they have the expertise. 2, they have knowledge, background, and relationships to be able to get it done efficiently. And 3, they can do it cost effectively. So that's where you could set up an affiliate relationship with CRE Credit Services as an originator that would allow you as an originator to focus on what you do best, which is originate loans, right? Get mortgages done. That's ultimately what your job is, right? and that's where you work with somebody like CRE Services. Now, part of the advantage of the course that we've put together here is to give you a broader knowledge of where that firewall is for you. What are the ones that are worth your time, and what are the ones that you should recommend or refer to CRE Services in the growth of your business? And of course, the other element of that is we'll show you how to use that base knowledge to get yourself in front of rooms full of people who are potential customers for you, both mortgage and otherwise. So anyway, I think we're going to kind of wrap up fairly close here. There's one last thing I wanted to share with you, as I do with everybody. Is, by the way, if you are interested in finding out a little bit more about the Maximum Acceleration Coaching Program and what we offer in group and one-on-one, as well as live training events that we can host for you or help you facilitate. We have kind of a sales rally in a box type program. If you'd like some more information about getting more in-depth business development coaching and training, welcome to take advantage of one of our no-cost, no-obligation strategy sessions. It's a one-on-one session with one of our actual coaches to talk about where your opportunities for growth are and how to execute on that activity plan. Again, no cost or obligation. If it's something you'd like to participate in, either hop to the website at mxlcoach.com/strategy and give us the information we need to be able to get that scheduled. Or if you're on the webinar live here and you want to go ahead and take advantage of that, go ahead and just post in the Q&A that you'd like to have one of those live one-on-one coaching strategy sessions. By the way, do please give us the best phone number and email address for our team to be able to get a hold of you so we can coordinate scheduling with one of our coaching team members for that perspective. Otherwise, as I always close out these programs, we are an action-oriented company. We want to take ideas and do something with them. Because, James has shared a ton of great information today. Hopefully, you've gotten a snapshot and insight into how to improve your practice as an originator and becoming an educator in your community for helping families improve their credit utilization and credit management habits. But ideas without action are useless. They have no impact or value to your business. So the first thing I want you to do before you jump on the next email or pick up that next phone call message is take 30 seconds to put an action plan in place. Ask yourself these 4 simple questions. 1, what was the most valuable thing you heard in the program? 2, what action do you need to take to make that part of your business going forward? What's the step-by-step action plan? 3, put a target date. When do you want to have that action implemented? And fourthly, who is going to be your accountability partner? In other words, who are you going to share that action plan with and ask them to follow up with you periodically over the next couple of weeks to make sure that you're following through on that plan and implementing and executing. You do those 4 things according to Brigham Young University's research study of 1993, you have a 95% chance of follow through if you do those 4 things. What's your action? Set a goal. Create an action plan, put target dates and deadlines on that action plan, and ask somebody to hold you accountable to those deadlines. You've got about a 95% chance to follow through. So, you've taken the time to invest it in this training program. You've got some great ideas that you want to execute and implement. Don't let that investment of time go to waste. Make use of it and do something with it. If there's anything my team or I here at Maximum Acceleration can do to help you and support you in that, please don't hesitate to reach out to us to ask. We'd love to help have that opportunity. Otherwise, guys, again, the live Winning the Credit Scoring Game, Becoming a Credit Educator program kicks off September 14th at 3:30 Central Time in the afternoon. It will run consecutive 5 Mondays in a row consecutively. You can participate for only $247 for that 5-part training program with James and myself. Starting on September 14th, just punch in the discount code CREDIT, C-R-E-D-I-T in all capital letters, on the mxlcoach.com/credit website. Get yourself registered for that class, and we'll get you up and running and ready to go. All right, guys. Well, thanks again for joining us on today's program. Again, my name is Eric Janesco, Maximum Acceleration Head Coach and CEO. We wish you all the greatest success. If there's anything my team or I can do to help or support you in the growth of your business, please don't hesitate to ask. And we look forward to seeing you on the next installment of the Maximum Performance Webinar Series. Continue to check the website and see what we can do. You can also check out our YouTube channel. Search mxlcoach.com. Pop on and catch some of the previous episodes in the series. Again, that website is mxlcoach.com. Is what you want to search on YouTube and find our YouTube channel there on the site. Otherwise, guys, thanks again for joining us, and we wish you all the greatest success. Make it a great week, everybody.
Take care, Eric. We'll talk soon, bud.
All right. See you, James. Thanks again.